So there are some different advantages and disadvantages in commercial real estate versus residential. And I get this question where clients are like, hey, I'm looking at investing in real estate. Which direction should I go? So tell me from a tax perspective, kind of the differences.
Sure. The biggest difference between residential real estate and commercial real estate is the depreciation period. So on a residential rental, it's depreciated over 27 and a half years versus a commercial property is depreciated over 39 years. So that's going to be the biggest difference. Otherwise, most of the general tax implications are going to be about the same. Another common difference that I see, though, is commercial real estate usually makes a lot more sense to do a cost segregation study, which breaks up the building systems to potentially accelerate depreciation. It's becoming more common with residential real estate because the cost of doing the cost segregation studies is coming down, but that's another big difference that you just see much more commonly.
And we're going to go on that subject here in a minute because that's like a whole other topic, but I do want to mention why I personally choose residential real estate over commercial. I mean, obviously I know it better because I'm in that world, but I find that the cost of appreciation is much lower and lower on commercial versus residential. Like they turn, faster. So people are buying more residential than they are commercial. So it makes the appreciation go up higher. So I personally like that. Also, the cost to obtain the property is a lot less. So a rental property and a commercial are, let's just say 25% down. There's different options, but I can obtain a $400,000 house 25% down for $100,000 versus a $4 million commercial property is going to cost me $1 million. So it's just the cost effects to get into that property and obtain it is a lot more achievable. And you still have the depreciation, even though it's a shorter term, but then the appreciation is also a greater percent.
And it's probably less liquidity too with commercial real estate. I would imagine they aren't as liquid.
We touched on cost segregation. So let's just touch briefly on this. This is a pretty complicated, we could talk about this for probably an hour. I light up when we talk about these things, but we'll just keep it short and simple. So just give us a brief synopsis on what cost segregation is.
Cost segregation in and of itself is breaking down the components of a building to accelerate depreciation. So if you just have a commercial building depreciated at 39 years, then it is what it is. You're depreciating the cost of the building, any improvements, less than over 39 years. When you split up the building systems, some of those systems have a shorter depreciable life, which means that you're accelerating those deductions. So it's a deduction you would get no matter what. If you kept that property for 39 years, you're going to fully depreciate it. However, the timing of the depreciation is accelerated, which is why it's really something that needs to be analyzed, whether it makes sense to do the full study. The cost of them is coming down, but it can be a cost prohibitive thing, especially if you don't intend to keep the property long term.
Okay. So it's better for long term, and it can be on commercial and residential, but like she said, the cost to obtain the study sometimes is pretty costly to where it might not make sense on a residential property unless you own a lot of them. So in my case, I personally have looked into this because I have a dozen properties. So I'm like, where can I get the best bang for my buck and the best tax write-off? So with the cost segregation, for example, instead of doing just an overall depreciation, they will depreciate like the flooring, the microwave. This is really good for commercial real estate for like a restaurant that's going to have a lot of like use and wear and tear. So you can break down those different things. And there's different materials too, like tile has a higher depreciation than like carpet because it costs more to obtain and it's a structured item versus kind of a filler item. So there's a lot that goes into that. But if you're in that investing world of commercial or residential, it's definitely something to look into. And I have a couple of contacts I can share.
Yeah. And another thing though, too, is going back to what we were talking about with passive losses. Passive losses can only offset passive income. So if you don't qualify for the real estate professional election and your income isn't low enough to take this like kind of standard amount that they allow you to deduct, you especially don't want to do a cost segregation study that's going to further exacerbate that loss because you're not going to actually be able to take it. It's just going to continue to carry forward.
Okay.
So definitely something to consider that if the rental property is already generating a tax loss and you're not able to fully recognize that loss, there's no point in doing the cost segregation study. I shouldn't say no point. It's definitely something that can be analyzed, but it would be something that you would more particularly want to analyze because there might not be as great of a benefit.
Okay. So if you have more passive income, that's where you want to look at a bigger passive loss. Is that,
yeah,
still a loss still?
You would want to increase your passive losses if you have passive income to offset it. So let's say that you have one property that's an Airbnb, not trade or business, that's generating a ton of income. That, let's say it's a $50,000 passive income over here, and then this property over here, without doing the cost segregation study, is a $10,000 loss. By doing the cost segregation study, you increase that loss amount. You can actually utilize that loss to offset the income on the other property.
Wow. Okay.
However, most rental properties are generating a loss anyway by virtue of depreciation. So they might be positive cash flow, but it's depreciation creating a loss. If you don't have passive income for those losses to offset, then
There's not really anything to write off.
right, yeah.